In 1929, a man named Roger Babson stood on a stage at a business conference and said 9 words that made him the most hated man on Wall Street. He didn't scream, he didn't panic, he simply looked at the audience of wealthy investors and said, "Sooner or later, a crash is coming, and it may be terrific." The audience laughed, the newspapers mocked him the next day. Irving Fisher, the most famous economist in the world, publicly humiliated him. Fisher declared that stocks had reached a permanently high plateau. He told the world that Babson was a fool and that the party would go on forever. 47 days later, the market collapsed. Irving Fisher lost everything. He died in poverty, a broken man. Roger Babson made a fortune, and his legacy survives to this day. But here is the secret that history books leave out. Babson wasn't guessing. He wasn't lucky. He had discovered a pattern. He realized that every major financial collapse follows a specific, unbreakable 5-stage sequence. It happened in 1929, it happened in 2000, it happened in 2008. And I have spent the last 3 months analyzing the data, and I have terrifying news. We are following that exact same sequence right now. We aren't in the early stages, we aren't approaching the danger zone, we are deep in the red. Most people will never hear this warning. They will be like Irving Fisher, celebrating the all-time highs right up until the moment their accounts go to zero. But you are going to be like Babson. I am going to walk you through all 5 stages today. I will show you the math, the behavior, and the trigger. Spoiler alert, we are much further along than you think. The algorithm suppresses this kind of bearish data. We need to hit 1,000 likes to push this warning past the censors. Subscribe now. Let's look at the blueprint. Stage 1 is the credit explosion. This is where it always starts, not with greed, not with speculation, but with debt. Before every major crash, there is a period where credit expands faster than the economy can absorb it. People borrow money they can't afford to repay to buy assets they don't understand. The buying pushes prices up. Rising prices make people feel wealthy, and feeling wealthy makes them borrow more. It is a feedback loop that feels like prosperity, but it is actually a trap being set. In 1929, the poison was margin debt. Ordinary Americans, factory workers, shoe shiners were putting down 10% cash and borrowing 90% to buy stocks. By the peak, total margin debt equaled the entire US federal budget. The whole country was leveraged like a hedge fund. Now look at where we are today. The official margin debt sits around $750 billion. The pundits will tell you, see, it's manageable. That number is a lie. It is the tip of the iceberg. The real leverage is hidden in the shadows where the regulators don't look. 1. Securities-based lending. Wealthy investors borrowing against their portfolios to buy more stocks. That's another $800 billion. 2. The options market. This is the new margin. Traders control massive positions with tiny amounts of cash. The notional value is in the trillions. 3. Corporate debt. Companies have borrowed over $10 trillion not to build factories, but to buy back their own stock and pump the price. 4. Government debt. We have crossed $36 trillion with interest payments larger than our defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it is on fire. Stage 2 is the concentration trap. Here is something they don't teach you in finance class. Crashes don't happen just because prices are high. They happen because risk is concentrated. When a tiny handful of assets carry the entire weight of the market, the system becomes fragile. All it takes is for one of those superstars to stumble, and it drags the whole world down with it. In 1929, the market was essentially a bet on ICA Radio Corporation of America. It went from $2 to $500. It was the Nvidia of its day. When ICA cracked, the market had no support. In 2000, it was the dot-coms. The Nasdaq was a bet on Cisco and Microsoft. In 2008, the concentration was hidden inside 5 megabanks holding all the derivatives. Today, the concentration is staring us in the face. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. These 7 companies now account for over 30% of the entire S&P 500. Think about what that means. When you buy a diversified S&P 500 index fund for your retirement, you think you are buying 500 companies. You are not. You are making a massive leveraged bet on 7 tech stocks. The other 493 companies are just window dressing. And here is the kicker. Passive investing has made this a ticking time bomb. Every time a worker contributes to their 401k, the algorithm blindly buys more of the biggest stocks. This pushes the price up, which gives them a higher weighting, which forces the algorithm to buy even more. It is a momentum machine that works beautifully on the way up, but on the way down, it reverses. If Nvidia misses earnings, the selling forces the index down, which forces the passive funds to sell, which drives the price lower. We have built a trapdoor under our own retirement accounts. Stage 3 is the smart money exit. This is the stage that makes me the angriest because it reveals how the game is actually rigged. Before every major crash, there is a distinct period where the insiders, the banks, the hedge funds, the billionaires quietly head for the exits. They don't announce it. They don't warn you. In fact, their public statements often say the opposite. They go on TV and tell you the fundamentals are strong. They tell you not to panic. And while they are talking, they are selling. In 1929, the Morgans and the Rockefellers started liquidating in the summer, months before the October crash. Joseph Kennedy famously sold everything after a shoeshine boy gave him stock tips. He realized that when the last buyer has entered the market, there is nobody left to sell to. In 2007, Goldman Sachs was famously betting against the same subprime mortgages they were selling to their pension fund clients. Regular Americans were the exit liquidity for the rich. Now, look at the data today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, and board members, the people who actually see the real numbers, are dumping their stock at a historic pace. The ratio of selling to buying is extreme. Meanwhile, retail investors have been pouring record amounts of money into the market via Robinhood and 401ks. Do you see the setup? The smart money is selling. The regular people are buying. The transfer of wealth is happening right in front of our faces. They are handing the bag to you before they detonate the building. Stage 4 is the liquidity illusion. This is the sneakiest stage because on the surface, everything looks normal. The S&P 500 is up. Trading apps are working. But underneath, the oxygen is being sucked out of the room. Liquidity is the ability to sell an asset without crashing the price. When liquidity is high, you can sell 1 million shares and the price moves a penny. When liquidity vanishes, you sell 1 million shares and the price drops 10% instantly. In 1928, the Federal Reserve raised interest rates to try and cool down the speculation. They drained the money supply. For a while, the stock market ignored it. It kept going up. But when the selling started in October 1929, investors realized with horror that there were no buyers. The bids had evaporated, the floor fell out. Now, look at the Fed today. They have raised interest rates from 0% to over 5% in less than 2 years. The fastest tightening in 40 years. They are pulling hundreds of billions of dollars out of the system every month, and the cracks are already showing. Remember March 2023? 3 major U.S. banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. These weren't small banks. They failed because the liquidity dried up. The Fed stepped in with a temporary band-aid, the BTFP program, to print money and hide the bodies. But that program has ended. The band-aid is ripped off. We are flying a plane with no air under the wings. The moment a shock hits, we won't glide down. We will drop. And that brings us to stage 5, the trigger. This is the one nobody can predict. And that is exactly what makes it so dangerous. Everyone asks me what will cause the crash. They are asking the wrong question. In 1929, the trigger was a minor fraud case in London called the Hatry Scandal. Nobody in America cared about it, but it forced British banks to sell American stocks. That selling started the avalanche. In 2008, it was Lehman Brothers. But it could have been Bear Stearns or Egg. The trigger does not cause the crash. The gasoline causes the crash. The trigger is just the match. We are standing in a room soaked in gasoline. Stage 1 Daddy has filled the room with fumes. Stage 2 has blocked the exits. Stage 3 has removed the fire extinguishers. Stage 4 Quiddy Drain has turned off the sprinklers. Now we are just waiting for the match. What will it be this time? Maybe it's a geopolitical escalation in the Middle East. Maybe it's a commercial real estate collapse that takes down a regional bank network. Maybe it's a fat finger trade in the $600 trillion derivatives market. It doesn't matter. When the system is this fragile, a butterfly flapping its wings can cause a hurricane. The window for this trigger, based on the historical data, is between late 2025 and 2026. You have a choice to make right now. You can be Irving Fisher. You can look at the all-time highs and tell yourself that this time is different. You can trust the experts who say the economy is strong. You can stay at the party until the lights go out. History tells us Irving Fisher died broke and broken. Or you can be Roger Babson. You can respect the pattern. You can accept that math always wins in the end. You can take your chips off the table, pay off your debts, and position yourself in hard assets before the panic starts. Babson didn't just survive the Great Depression, he used it to build a legacy that lasted a century. The difference between them wasn't intelligence, it was humility. Babson was humble enough to admit that trees don't grow to the sky. The blueprint of 1929 is lying right on top of 2026. The lines match perfectly. I have done my job, I have shown you the map. Now, you have to decide if you are going to walk off the cliff or turn around. But knowing the pattern isn't enough. You have to understand why people failed to act in 1929, even when the signs were obvious. It wasn't ignorance, it was normalcy bias. When the crash began in October 1929, the initial dip was bought up by bargain hunters. They thought it was just a correction. The newspapers ran headlines saying banking system sound and brokers see technical adjustment. This is the psychological trap you are about to face. When the 2026 crash begins, the media will not tell you to panic. They will tell you to stay the course. They will interview experts who claim the bottom is in. They will gaslight you into holding on to your falling assets until it is mathematically too late to exit. In 1929, the people who lost the most weren't the ones who sold at the bottom. They were the ones who held through the first drop, waiting for a bounce that never came. They watched their fortunes evaporate day by day, paralyzed by the hope that the old world would come back. It didn't. The market fell 89%. It took 25 years, an entire generation, just to get back to break even. You do not have 25 years to wait for a recovery. The buy and hold strategy only works during the expansion phase of the long-term debt cycle. We are at the end of that cycle. In the deleveraging phase, buy and hold becomes buy and fold. The only strategy that survives stage 5 is capital preservation. It is better to be out of the market 2 years too early than 2 days too late. The early seller looks like a fool for a while, the late seller looks like a victim forever. If you want to know the specific portfolio that Babson used to survive and the modern equivalent for 2026, you need to subscribe. I am going to break down the survival asset allocation in the next video. Don't be a victim of history. Be a student of it. Comment I am Babson if you are ready. Class dismissed.